Hi, everybody. My name is Marc Finer, and as you heard 5 minutes ago, I'm a tax and business attorney with the law firm Cummings Lockwood. And, although the description of the presentation says Legal Aspects 101, there's actually a lot more to starting a new business than just thinking about the legal aspects. So, although that's the title, we're going to get into a bit more about starting a business than just the legal aspects. That handsome devil is me. I've been practicing law for about 25 years. I know I look barely legal, but it's true, about 25 years. My primary area of expertise is tax, but really tax is generally a component of business transactions. So I've worked on dozens and dozens of transactions, and I've run the transactions where it may have started out as a tax issue, but has become much more of a full service transaction. So I help clients with M&A transactions, whether it's reorganizations, restructurings, acquisitions, sales, dissolutions, and formations. I also do a little bit of controversy work, although I found that 9 times out of 10 there's really no controversy. The person just didn't pay their taxes and wants out of it. So that's just part of what I do. And my primary client base are individuals, closely held businesses, families, entrepreneurs, corporations, tax-exempt organizations. I don't do really any work with public companies. It's really more closely held, a number of owners, whether they're family owners, whether they're unrelated individuals, but really smaller businesses. So the first thing we're going to talk about is just an introduction to business law. And before we really get into the meats of the discussion, I just wanted to give you, an overview of what you should be thinking about when you just say, hey, I want to start a new business. To successfully start a new business, you have to set goals and you have to set milestones. And everybody can talk, hey, I got this great idea. I want to, start a new business. I want to start a new, I want to, create a new product, or I have this great marketing idea. But if you don't have a business plan until you have specific targets that you want to think about and how you're going to produce something, when you're going to produce it, and what you're going to produce. And the only when you've conceptualized that idea into realistic goals are you going to be able to actually implement your plan to start a business. And so these are some recommendations that I've found to be helpful in setting your goals. And the first one is formalizing your goals. You have to conceptualize an idea and make it actually into a structured thought and formalize it. For new business ideas, that's actually called a business plan. So that is going to be the bedrock of starting a new business, coming up with an actual business plan. Execution. Most of the time, business founders know what needs to be done to reach the goal, but they don't know how to actually do it. Like they're actually stuck in quicksand. I don't know how to get started. Execution is a key to success. And seizing the moment. Given the number of goals a business founder might be pursuing at once, it's not surprising that business owners oftentimes miss opportunities to act on a goal because they fail to notice the opportunity. And one thing I've seen is a business owner that has their hands in 5 businesses, 7 businesses, 10 businesses. And quite honestly, most of the time those business owners fail. And they fail because without focusing on a single goal and a single business, you just get distracted by all the noise that's associated with trying to run multiple businesses at the same time. You have to know what to do. Experience in what you want your business to be and running the business is valuable to you, and it's going to be valuable to your company, to your customers. I see oftentimes, I want to start a restaurant. Why do you want to start a restaurant? Because I like baking. That's not, a reason to start a restaurant. The people that are successful are the people that have worked in restaurants or have families that have run restaurants, not the people that like baking or not the people that like to barbecue and think that they can just, create a business out of it. Putting your shields up. Goals require protection. Distractions, temptations, competing goals can steal your energy, can steal your attention, and essentially exhaust you and sap your motivation. So as a business owner, you have to focus on creating value and spend your time on the critical issues that are important to actually building and growing your business and shutting out the noise while you're doing it. And the last thing, know how you're going to do it. Achieving your goals requires actually careful monitoring. If you don't know how well you're doing, you can't adjust your actions, you can't change your strategies. And for that reason, you need to check your progress often against milestones and financial projections. And again, that goes back to the business plan, which is going to be the bedrock for starting your business. So let's talk about relationships. That usually gets a bigger laugh then. All right. For those of you that remember, I don't know if all of you are old enough to remember Miss Piggy and Kermit the Frog. So for those that do, kudos to you. So when you enter into a business relationship, whether it's with an employee, whether it's with a customer, whether it's with a vendor, or between the company and its owners, you're creating a relationship. And it's always important to think about the impact of each relationship, the benefits and the burdens of that relationship, and how to protect your business in the event of a failed relationship. When people come in, they're all excited about starting a new business, and one of the first questions I always ask is, what's your exit strategy? And the response is, what do you mean my exit strategy? I came in here to start a business. But unless you can think about the whole life cycle of the business, when you're starting out, you run into problems later on down the road, or you could run into problems later on down the road that most people just don't think will ever happen to them, but I assure you it happens. Shoot. Okay. Who do you have, let me go back. Who do you have relationships with? Essentially, it's who's in your network. So your network can be professional advisors, like your attorney, like your accountant. It could be mentors. It could be business contacts. It could be other people in the industry. And often I have found people are more than willing to help other people get started, even if they're in the same industry, because they want the industry to actually grow. And those kind of people, your professional advisors, your mentors, your business contacts, can often be the most valuable tool in your toolbox when you want to start a business. And shameless plug for the Chamber of Commerce, your Chamber of Commerce can actually be, very helpful in helping you start a business. The members of the Chamber of Commerce are generally the people that, you've seen around, that you trust, that you've developed relationships with. I wouldn't know half the people I know in West Hartford if it wasn't for the West Hartford Chamber of Commerce. Be a relationship counselor. And what that means is you have to understand your relationships. Whenever there's an interaction of two people, there's going to be legal issues. And so keep your eyes open, keep your ears open, and be aware of information and power asymmetries. For example, if you want to start a business and you need money, there may be a power asymmetry between you, who's going to put in the sweat equity, and the person who's actually investing in your business, who may want their cash back before you see a dime. And so understanding those relationships and those power asymmetries will help you, move forward as you begin your business. So most people form businesses through an entity. They don't just put a shingle out their door and say, hey, come, buy my product. And most people do it through, I'm going to talk about 3 kinds of entities that most people do it through. But let's just talk about companies in general, entities in general. Why would you operate your business through an entity? One of the big reasons is, and maybe the biggest reason, is liability protection. If you form your business and operate your business through an entity, while the assets of that business are exposed in the event of some liability, you have a debt, a bank loan that you don't repay, somebody slips and falls on your property. The benefit of your business being in a company is that there are guardrails around your liability. And what that means is The victim or the bank can only go after the assets of the actual company itself. They can't go after your house. They can't go after your car. It also helps you to organize relationships. Companies go through transitions, so they begin, they operate, and they end, and it's best to plan ahead. And as I said, one of the first discussions I have for new business owners is exit strategy, because what happens if an owner dies? What happens if an owner becomes disabled? What happens if an owner, who once, worked as hard as you did, decides that they don't want to work as hard as you do? And what happens if an owner gets divorced? I always say, do you like the person's spouse? Because, you may wind up in business with that person's spouse if things go south. Another reason to form a company is to attract investors. Companies are much more willing to invest in your business if they are investing in a company and can take ownership of that business in some way, shape, or form, rather than just giving you money and saying, Godspeed, go start a business. And the other big reason is to obtain the benefits of settled law. There is, books this thick on corporate law, limited liability company law, and partnership law that, depending on your state, that's settled law, and that's a way, if something does go wrong, you know where to look, and you know for certainty what the outcome should be. So this question I get a lot is when to form a company. My wife has a friend who bakes sourdough bread, and she's starting to think about whether she's going to bake sourdough bread as a business. And she said, should I form a limited liability company? And I said, maybe off the bat, you don't need to form a limited liability company because you need to pay legal fees to form a limited liability company. There doesn't seem to be a lot of liability in the sourdough bread market. And quite frankly, she's not at the point where she's really making any money that warrants her doing her business in a company. So when would you maybe want to start a company? You want to start a company when you're determining equity issues, such as ownership. You can't give a piece of you to somebody who wants to invest in your business. You can give them, though, equity, whether that's stock, whether that's a membership interest in a limited liability company, whether that's a partnership interest in a partnership. That's a tangible evidence of ownership that you are actually giving the person, and with that, that person has rights that they wouldn't necessarily otherwise have if they just gave you the investment. If you're about to take on a liability, if you're signing a contract, if you're hiring an employee or a contractor, if you are entering into a loan, you might want to do that through a company because, again, if you're taking on a liability, you want to protect your personal assets from liability in case something happens with the business. Need for funding. Again, as I said, investors are much more willing to invest in you through an entity where they can take back a tangible piece of ownership rather than simply just giving you the money and saying, I trust you to run your business. So, choice of business entities. I'm going to focus on really the two choices that people make, and one is really like 1 and 1A. The first one is corporations, which is either a C corporation or an S corporation, and the other most popular choice, probably the most popular choice, is a limited liability company. So with a C Corp, some nice things about a C Corp is you can have an unlimited number of owners and an unlimited type of owners. You can also have different kinds of stock, like common and preferred. So common stock is the voting stock, and the preferred stock gives those holders priority rights in terms of income, in terms of dividends, before the common shareholders actually share in the profits of the company. A corporation is also managed by a board of directors and its officers. The officers run the day-to-day. The board of directors makes the very high-level decisions and decides actually who the officers are going to be. An S corporation. So an S corporation has a lot of the benefits of a C corporation, but one of the biggest benefits is it's called a pass-through entity. And what that means is the entity itself doesn't actually pay taxes. It's the owners of the entity that actually pay taxes. But limitations for an S corporation are you can't have more than 100 owners, and only certain types of shareholders can actually be shareholders of an S corporation. You can't have entities being shareholders. You can only have certain kinds of trusts being shareholders. So it's a little bit more limiting in that way. And lastly, you can only have one type of stock, common stock. So everybody has to share in the profits equally. Limited liability company. So this is the most popular choice because to some extent it combines the C corporation and the S corporation, but is better in many respects. Like the S corporation, it's passed through taxation, so the entity itself doesn't pay tax. And I'll get into that in a second. It's a very flexible structure. You don't have to share profits and losses equally. You can share them among the shareholders really in any way that you want, as long as it captures the business deal among the shareholders. So for example, sometimes like I had mentioned earlier, you have somebody that puts in a lot of capital and somebody who does the sweat equity. So what's going to happen when the company starts making profits? Does the investor get his money back first? Do they share everything 50-50, notwithstanding the fact that the investor actually put capital in? So all of those things can be addressed in a limited liability company in a way that they can't be addressed in a C corporation or an S corporation. The other really fantastic thing about an LLC is the ability to issue profits interest. If you give somebody an interest in an LLC generally that has value, that person is taxed on the value of what they've received. So if you have an LLC worth $1 million and you give somebody 10% interest in that LLC, they're taxed on $100,000 immediately because they've gotten something of value. They've gotten something worth $100,000, right? In an LLC, you can issue something called a profits interest. And what that means is it only allows the person receiving the profits interest to actually share in the appreciation of the entity above what its current value is. And it's not taxed because it's worth zero on the day that the person gets the interest, because if the entity were liquidated the next day for that $1 million, the person with the profits interest gets nothing because they would only get a share of the appreciation above the $1 million. And that can be really valuable for employees and people coming in at later stages of the business, because you've done all this hard work to make the value of the business $1 million. You don't necessarily just want to give a share of that away to somebody coming in for the first time. I've touched on some of this, thoughts on taxes, maybe my favorite slide. As I said before, limited liability companies and S corporations are pass-through entities. That means they don't pay federal income tax. Rather, all the profits pass through the entity and are taxed at the owners, who pay tax on their personal tax return. So the tax rate generally applied at the federal rate for that is, the highest rate would be 37%. It's best to use this kind of entity if you plan on taking money out of the entity, because the tax rate is 37% on proceeds, the maximum rate. A C corporation has 2 levels of tax. It pays taxes, the entity pays tax itself, and then when the profits are distributed, the shareholders pay a second level of tax. And a C corporation pays tax at 21%, but when you combine that with the tax that the shareholder pays on distributions, it's about 40%, so about 3 percentage points higher than you pay through a pass-through entity. You would want to use, a lot of startups use C corporations because they don't plan on taking money out of the business. They plan on just continuing to pour the profits back into the business. And if you're just going to pour the profits back into the business, you might as well pay tax at a 21% rate versus the 40% rate, which would apply if you actually distributed all of those profits. So I'm just going to touch on this because I do get questions on this from time to time, and it's actually become, with the reduction in the corporate tax rate to 21%, this has become much more popular. There's actually a provision of the code that says if you set up a C corporation correctly and operate it correctly for at least 5 years, if you sell the stock of that C corporation, the first $10 million of gain is not subject to tax. So if anybody knows anybody in that position, I want to meet them right after the meeting. And so a lot of entrepreneurs will start as C corporations because they know they've started businesses before. They know their business that they're starting is going to be a home run. They know that it's going to be worth, millions and millions of dollars when they're ready to sell it. And so this is a great way of, taking advantage of that gain exemption. And sometimes if you're lucky enough and your business is worth more than $10 million, maybe $20, $30 million, we can actually help you plan to actually stack that exemption. Maybe you give some shares to your wife. Maybe you put some shares in a trust, because each of those individuals and trusts are separate taxpayers and they all get the same $10 million exemption. So now you've taken one $10 million exemption and made it $30 million by doing this kind of planning. So individual liability, we talked about how if you operate through an entity, it's really only the entity's assets that are exposed in the event something terrible happens. But there is no liability shield, and you can't run for cover under your entity if you sign a personal guarantee on a debt or an obligation for your own individual negligence or wrongful misconduct, or if the victim is able to, what's called in legal terms, pierce the corporate veil. So piercing the corporate veil is a big one. You can be personally liable for the debts and the liabilities of a company if the plaintiff's able to pierce the corporate veil. And when can a plaintiff pierce the corporate veil? You operate your business, but you fail to disclose to the other side that you're not operating your business as Marc Finer, that you're operating your business as Marc Finer LLC. So the person on the other side of that business deal thinks they're dealing directly with you rather than a company that you own and operate. That could be the case, you fail to disclose the name of the entity, your invoices don't say the name of the entity, your business cards don't say the name of the entity, correspondence don't have a signature block that says the name of the entity. These are all cases where, because the individual thinks they're dealing with you, they're entitled to go after you personally. You commingle your business and your personal assets. I've seen it many times where a business owner will use the business to pay for, vacation trips, pay for boats, pay for cars, essentially using the business bank account as their own piggy bank. And if you don't respect the separation between your business and your personal life, it all gets meshed together, and a plaintiff can go after you personally because you haven't respected the separation between your business and your personal life. So make sure, everything says, LLC or, Inc. on the end of it. Make sure you open up a separate bank account, for your business so that all of your funds and your expenses are paid through the bank account. Make sure your business pays its own taxes so that, the IRS and the DRS can't go after you personally for those taxes. And lastly is just failing to respect the corporate formalities. If you're supposed to have meetings on an annual basis, have the meeting on an annual basis. If you have an agreement, an operating agreement or a shareholders agreement, make sure you follow those agreements when you're operating your business. So ownership in your company. So ownership in your company is called equity. That's just a general term for your stock, your membership interest, your partnership interest. It's really all called under the umbrella of equity. And when you think about it, equity is actually like oil. It's a precious and it's a non-renewable resource. And what I mean is, once it's gone, it's very hard to get back. So for non-investors and even founders of the company, you always want to consider, before you just give it away, things like vesting and restrictions on transfer. So vesting would be, you give the person equity over the course of time. You don't just give them, 20 shares day one. Maybe it's, or let's say 21 shares day one. Maybe it's 7 shares if they're with your business in a year. Maybe it's another 7 shares if they're with your business for the second year. And maybe it's the last 7 shares if they're with your business for the third year. You could also do it through we meet certain targets, you get equity. You know, if our profits increase by 10% next year, you get a share of equity in the company. So you also want to ask yourself, is this really somebody I actually want to be in business with? You know, before you give somebody equity, you want to make sure that you actually like this person, you have the same mindset when it comes to your business, and you both, you know, have the same mentality in terms of your roles, how hard you're going to work. A lot of times it could be age, you know, if somebody's 40 and somebody's 80, that might not be a great, you know, match for you in terms of your business. So always think about that. And again, it comes back to relationships, right? You want to make sure, first and foremost, you have a good relationship with your business partner. So now we're going to talk about working with partners. Do you have partners? You have partners. If you have more than one partner, you have to think about things like, what happens if somebody, you know, an owner wants to sell his shares and get out? What happens if an owner doesn't contribute to the company like she promised when you started out? What happens if an owner becomes disabled or is no longer able to help the company? And what happens if an owner dies? Like, these are things you need to be thinking about, even, you know, when you start your business and have partners day one. As I said before, companies have life cycles and they go through transitions, and all the questions that I just asked you in the previous slide represent transition events. And well-planned businesses do their best to resolve those issues ahead of time. So to the extent you can have an agreement that addresses what happens if somebody dies, what happens if somebody becomes disabled, what happens if somebody retires, to the extent you can have that in a document before it actually happens and have addressed it in a document before those events actually happen, it will be much easier to transition out of those events and resolve those events than if you're trying to fix everything while, you know, the event is actually going on. And how can you do that? You can do things like buy-sell agreement. You know, you want to get out of the business, I get to buy your interest from you before anybody else gets to buy it. Shareholders agreement, LLC operating agreements, these are the documents that govern how the business is going to be run. Not just, you know, part of it is from a tax perspective, who gets what share of the profits, but it's also who makes major decisions, how are major decisions made. If you want to enter into a loan for $100,000, does everybody get to chime in on that, or did two majority shareholders necessarily maybe get to chime in on that alone? So these are things that you want to do and address at the beginning. Limitations on equity transfers. We talked about how, you know, it's oil and you don't necessarily want to just give it away. Often in our agreements, we have a section that talks about permitted transfers, and oftentimes it's a transfer to another, you're allowed transfers to other family members, transfers to entities that you control. Sometimes you do estate planning and transfer interests. But you also you want to block non-permitted transfers, right? So if it's somebody you don't want to be an owner with you, you should have the ability in your document to be able to block that before it actually happens. Right of first offer. What that means is that simply if your partner wants to sell his shares, you get first crack at buying the shares. Right of first refusal. Your partner can go out and market his shares, but when he gets an offer, you have the right to match that offer. Co-sale rights. Your partner somebody wants to buy your partner's shares, you have the right to sell your shares to that same buyer. Your partner wants, you want to sell your shares, you have the right to drag your partner along so that the buyer can buy the whole company rather than just your shares if that's what the buyer wants to do. So I'm not an IP lawyer, but it is important to just mention brand protection. Brands have values and in and of themselves separate and apart from the actual owners of the business. So anyone who uses your name or sells your product represents you and represents your business. So you need to protect your brand when it's part of your business. And that can be including specific provisions in agreements you create when you sell or distribute your brand. It's with referral relations and, again, relationships. So I can just talk about this for a bit, independent contractor versus employees. Essentially, the difference is the ability to control the person. So, for example, the person that comes to paint your house, that's an independent contractor. You can't tell them when to show up. You can't tell them how to paint your house. All you can tell them is paint my house and I will give you X number of dollars to do that. An employee, you actually have control of them. You can tell them what time to come to work. You can tell them what to do during the day. And one of the big expenses of having an employee is all of these things that you have to comply with. You have to pay payroll taxes. You have to get workers' comp insurance. You have to get unemployment insurance. You have to comply with wage and hour laws. So for the most part, businesses would rather, in many cases, deal with an independent contractor so as not to have to deal with this stuff, but it's not really up to the business owner to decide. It's really based on what the facts and circumstances say as to whether somebody is an employee or a business or an independent contractor. Let's see, I'm going to skip that. So let's talk about for a second the employer-employee relationship. It's one of the most complex relationships that you're going to have from both a personal and a professional perspective. As in most relationships, two parties are going to share a lot of time, a lot of ideas, a lot of information, and a lot of assets. And an employee has unique access to the employer's proprietary information. So what your goal should be when you have an employee is to set boundaries for the relationship and ensure that your business retains its assets and value if the relationship ends or goes sour. How do you do that? You can do that with things like an assignment of inventions agreement, a confidentiality and non-disclosure agreement, non-solicitation, employee can't leave and start trying to poach your other employees, can't start poaching your other clients, and non-competition agreements. Sometimes we see if you leave, that's fine, but you can't operate the same business in a certain geographic area. You can't operate your business in Hartford County if you leave. And that's just a way to protect your business should an employee decide to leave. I'm not sure how much this applies to this group, but it is something to think about if you actually do produce something. It's who owns an invention. The person who creates the invention is typically the owner of the invention, but what happens when the employee creates an invention for the employer? The employer owns the invention, but where you get into some gray areas is what happens when the employee creates the invention during non-working hours? What happens if the employee creates the invention that has nothing to do with work, but actually uses the employer's tools in order to create that invention? So, as I touched on in my prior screen, the assignment of invention agreement eliminates that issue because it basically would say that the employer owns the invention. So lastly, a quick primer on compensation. Compensation through equity can be a really powerful tool in incentivizing employees, creating loyalty for the employees, and keeping the employees. It can be done in a multitude of ways. You can actually give them equity. You can give them options to purchase equity. You can give them equity in the company, but say if you're not here in a year, I get to take it back. You can give them what I call profits interest. You can give them phantom equity, which they don't actually own equity, but they own the value of the equity. So if the company is sold, even though they don't actually own stock, they're treated as though they actually do own stock and reap the benefits in the same way an actual shareholder does. But again, you want to be careful about vesting, that you may not want to give your employees these sorts of equity right off the bat. And with that, my last slide is nothing I said you can rely on for the presentation. But no, seriously, there are a lot of mines that you can step on when you are starting a new business. Use your resources, use people you know. Speak to professionals, speak to attorneys, speak to accountants, speak to others in your industry, because it will go a long way towards helping you start and become successful in your business. Thank you.
A question about business name and LLC. Like, what if businesses, like, for example, me, it is our many LLC doing business as our many custom doing.
Right.
Do we have to put all together?
No, but what you would actually just use the doing business as and you would want to file that doing business. There's a form that you would file in West Hartford with Town Hall to let, that lets everybody know that, Armani LLC, but really the way you're operating your business is the DBA. And sometimes when you're starting your business, like the woman with the sourdough bread, I said, maybe what you want to do is not form an LLC, but just file the form that you're doing business as sourdough bread, business. I don't know what the name of the entity, the name of the business would be. But that's another way. It's not really that common to see the doing business as. Some people do it, just to protect identity, protect location, et cetera, but it's not that common for people to do it.